Hello, my name is Peter Perovalaris. I'm a director at Summit Business Consultants. I'm a CPA, and I'll be talking to you about investing in property through your SMSF. Did you know that investing in property through superannuation is the most effective and efficient way to invest your savings? And I'm going to prove to you that that's the case. I'm going to take you through some steps that show you how this works, and the reason why a lot of people don't actually know that this is a benefit. Now, we need to look back at the history of superannuation. What's been happening over the last 10 or 20 years is that we've always had the very low tax rate for superannuation funds, which is at 15%. It's the lowest tax rate of any entity in Australia. The second thing that's happened is that the Keating government brought in the 9% SGC, superannuation contribution, which all employers have to pay for their employees. And that's going up to 12% over the next few years. And the third thing that's happened in the last 5 years since 2007 is that superannuation funds can now borrow to buy property. So the convergence of those three things for the very savvy investors means tremendous opportunities. Now, if you're just relying on buying a property and the value of the property going up over the long term, a lot of things are out of your control. The markets, interest rates, many things are out of your control. So that's not what we're here to show you. I've bought and sold properties over the year, not in a big way, but I have done it. But the lessons that I've learned from that are that the best way to improve my equity and increase my equity in a property is to pay it off. And the faster that I can pay it off, then the better I'm going to be. Because what does that do when you pay it off faster? You pay less interest. And then you have more cash and equity that you can reinvest into other investments. So what this is about is bringing together those three powerful elements: the low tax rate, the superannuation contributions that you're able to make, and the fact that you can borrow to buy into property. All those together, when harnessed, are very powerful to pay off the loan very quickly. Now, the thing that you have the most control over when you're buying a property and looking to pay it off is the rate at which you repay it. The other things are largely out of control. When I talked about the contribution rate, the minimum rate, the tax rate, the markets, all those things are largely out of your control. The one thing that you can control better than anything else is how fast you repay the loan. So I'll walk through an example to show you. If we were going to buy a property for $500,000, and we were going to borrow $325,000 of that, I can tell you that if you went to buy that property in your own name and negative gear it and pay it off over 15 years with a 7% interest rate throughout the term of the loan, that you would have to contribute out of your pocket about $1,670 per month. Okay, that's about close to $20,000 per year. Over the course of the 15 years, you will pay out of your pocket $299,000. You only started with borrowing $325,000. So you've actually spent $299,000 to get yourself $325,000. That's a very low rate of return. Which goes back to my earlier point that if you're just buying the property for the capital gain, then that's really effectively all you're going to get is the capital gain. And doing it this way is not very effective. You're much better off going through a superannuation fund, and the reason is this: because instead of having to contribute out of your own pocket $299,000, the actual amount that you'll contribute through a superannuation fund is $230,000. Now that means that your margin here is you've created $95,000 of equity. And that works out, $95,000 over 15 years, works out at a return of 6.3% per annum. That's flat, that's very simple. However, at 6.3% per annum over the course of 15 years without any capital growth. You're not relying on the capital growth in order for your investment to work. Now that's a very simple and quick example, and it shows you how the investment can work very favourably for you. If you'd like to find out more, please go to our website, summitconsultants.com.au. My name is Peter Pervalaris, 0419 623 516. Thank you. Questions? Are there any questions? Yes, sir, over here.
Yes, I have one. For the benefit of my background, would you please go into a brief explanation of how a self-managed super fund might work?
Okay, well basically you set up a special purpose trust where you and up to 3 other people can be the members of that trust, of that super fund, and money goes in. If you've got money out there with managed funds at the moment, you can bring that money in, or you can start contributing from your employer or from yourself. That money goes in, it then basically gets invested wherever you want. And that's the whole point of having a self-managed fund, exactly what it means, self-managed. You decide where you invest the money rather than some unknown fund manager. You get to monitor the performance of your investments, you get to choose the particular products, such as property, and it's entirely in your control.
The other question I've got is, I've heard out in the marketplace another school of thought that says instead of paying the equity off in the property, that because paying the equity off is not necessarily a tax benefit to me from what they tell me, it's better to reinvest that money in the fund and to maybe buy another property. Do you agree with that?
Look, I've heard that as well, and there are promotions out there for that type of thing. You need to look very carefully at those. What they are relying on is the capital growth of the property and multiple properties. Because if you think about it, if you have one property for $500,000 and that grows 10% over a period of time, then that's grown by $50,000. But if you've got 4 properties at $500,000, that's $2 million. That 10% growth is $200,000 of equity that you've created. But of course, it relies on getting that capital growth. What I'm talking to you about is whatever capital growth you get is cream on top. This system works because it's actually creating equity irrespective of what the market does, because you're paying off the loan. That's where you're creating the equity, not by unreliable and unpredictable capital growth.
The other question I've got is, my brother-in-law the other day was talking about strategies where somebody approaches 55 and 60 and gets ready for retirement out of a self-managed fund. What strategies are available to minimise tax?
Well, once you turn 60 in any fund, whether it's self-managed or not, once you turn 60, then all income that comes into the fund can come back to you tax-free. So that's the main thing. There's another aspect as well, that now with the new tax rates that have come in since the 1st of July, that up to the first $18,000 of income that you receive that's in your own name, so if you've got assets already that are not in your self-managed super fund, it's not a problem to have some assets outside your self-managed fund. If you're thinking, oh well, I haven't got one set up, so I've missed the boat. No, you haven't. If you've got assets outside, it wouldn't pay you to transfer those in because there's stamp duty and possible capital gains taxes, so we wouldn't do that. But at least the income that you're getting, the first $18,000 outside the fund is tax-free. Whatever you're getting inside the fund after age 60 is tax-free as well.
And the last question I've got is, do I need to see a licensed financial planner to set up a self-managed fund and to get involved in property and all these things that you're talking about, or can I just come and see you guys, for example?
Look, there is talk by the government of changing the rules about what sort of licensing you need to have, but the latest information we have is that the accountants will continue to be able to advise on this, on setting up superannuation funds. So yes, there's no problem coming to see us about it. You don't have to go to a licensed financial planner. And last question? And
if we wanted to gather or get more information or contact you guys, how do we go about doing that?
Summit Consultants, you can look up our website, www.summitconsultants.com.au. Phone number 0296875900. My number is 0419 623 516.
Thank you very much.